What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help out the YouTube algorithm. In today's video, I have the start of my monthly portfolio updates, which will be somewhat similar to my weekly updates. However, I will dive into a lot more detail about the fundamentals of the portfolio and how it changes month by month. In future episodes, I will outline my biggest risers and fallers for the month and try to analyse why these changes have happened. So kicking off April's review, we can see that the portfolio is made up of 12 shareholdings, of which the new additions for this month being Pfizer, MasterCard, Uber, Coca-Cola, and also averaging down my position in HSBC. This brings my capital deployed in this count for the month to around £2,400. And my total returns for this portfolio is negative 9.91%, with total dividend return of £18.05. As you can see, my best performing stock in this portfolio is MasterCard, which is up 10.3% at the time of making this video. An article taken from MarketWatch explains that this is down to receiving game-changing e-commerce momentum, in which it stated that card-not-present transactions accounted for 50% of volumes in April, up from 40% a year ago. Another key point to take from the article was that the company's other revenues category grew 26% or 28% on a currency-neutral basis, including a 6-point impact from acquisitions. Another company of note worth mentioning is Johnson & Johnson, which is currently up 8.8% at the time of making this video. Johnson & Johnson's rise can be put down to its earnings report. If we look at the article from Forbes, it states that the company saw its first quarter profits surge amid higher demand for over-the-counter medicine and packaged consumer goods during the ongoing pandemic. Johnson & Johnson reported profits of $2.30 per share, higher than the $2 per share forecast by analysts, and sales rose 3.3% from a year ago to $20.7 billion compared to the $19.5 billion analysts expected. The stock also jumped on news that the company raised its quarterly dividend by 6.3% from 95 cents per share to $1.01 per share. A pleasant surprise for investors who have been bracing for the impact of the pandemic on corporate earnings and reports. If we look at the contributions returns pie, we can see a lot of red, of which the majority being made up of Legal & General, Aviva, Virgin Money and HSBC, of which are all British finance companies, which shows I'm a bit overexposed to this sector, and also down to investing heavy before the crash. However, some positive news is that my recent additions of Uber, MasterCard and Pfizer are all positively contributing. Looking at the diversification pie, we can see that the portfolio is well diversified in terms of company holdings, with no shareholding having a considerable holding over the other shares. However, if we look at the diversification branch, we can see that the portfolio is a little skewed to the banks, making up 27% of my portfolio. Simple Wall Street gives the portfolio a PE ratio of 19.99 and also undervalue it by 44% in comparison to its fair value. This is very encouraging, and according to analysts, this portfolio is set to grow very nicely in the future. Looking at future growth, Simply Wall Street and its analysts predict annual earnings growth of 25.1%, which is above the market of 17.9%. Also, revenue is set to grow 6.6%, which again is greater than the market of 3%. With both of these combined, we can see that my portfolio is predicted to outperform the market. My portfolio has a past performance of 4.46%, which is lower than what I'm aiming for in the future. However, this portfolio is very much geared towards the future and not something I'm too concerned about. My portfolio has a return of equity of 25.9%, which is double of that of the market. Looking at the financial health of my portfolio, we can see that the portfolio debt level is 126.54%, which is quite concerning and something I would like to see come down in the future. However, it must also be said that debt isn't always a bad thing, and in fact when a company becomes very large, they can acquire debt, such as loans at very cheap rates, which could be used to grow the company. Finally, my favourite part of the update is the dividend section. We can see that the portfolio yield is around 2.48%, which generates me an income of £169 per annum, with my biggest contributors being Legal & General, AT&T and Pfizer. It must also be said that the yield and annual income has taken a hit due to companies such as UK banks now no longer paying a dividend, However, once this pandemic is all over, I expect this to rise very nicely and gain me some lovely passive income. So that wraps up this video and this month's portfolio analysis. This episode has mainly outlined the current portfolio and set the foundation for this series. In future episodes, I will be giving a side-by-side comparison on how the fundamentals have changed and what has contributed to them. So thanks for watching. If you've liked the video, please drop it a like, subscribe if you want to see more content like this, and if you've missed previous updates, there will be a link to the playlist in the description. And until next time, peace.